We had pretty interesting things happen this week in the stock market, especially in the economy. We're finally starting to see some weaker economic data in terms of the ISM manufacturing and especially the jobs report that we had this week. I'm going to talk about all of that stuff and what it really means for the market. Now, taking a first look at the ISM manufacturing PMI, it's now around 46, which is a disaster. Normally, if it's under 50, it means it's contracting. And the forecast was around 47.5. Now it's 46.3, which is very, very bad. And if you look at the trend, the ISM has been going down every single month. And once the ISM goes below 50, it normally means that it's contracting. And this is bad news that the economy is actually suffering, especially the jobs report. If we look at the jobs report, it's still much higher than what it was in 2019 before COVID, but the jobs opening have started to come down and they came down sharply in February. But all of this means that the economy is very, very weak. But this is actually good news for the market because all the market cares about, and it's very sad, but they care about Jerome Powell and liquidity. All they care about is when the Fed is going to pivot. When are we going to start doing QE again in a massive, massive way? They don't care about valuations. They don't care about all those things. All they care about is when Powell is going to pivot so we can just, buy everything again and then go 100% into the ARK innovation growth stocks and all these kind of things. And this is the most likely, scenario this time. But what investors are overlooking is that, yes, such bad economic data might be good news that maybe Powell might actually pivot soon, but it's actually bad news for earnings, which I believe they still have a long way down to go. Maybe not immediately, but they're eventually going to get revised lower. And I said the market will soon wake up that lower inflation is bad for earnings. The only reason inflation is lower is because the economy is weaker and energy is not here to support EPS growth. I mean, the only reason we're having inflation coming down is because the economy is weak, because jobs are starting to go down, because the ISM looks like a disaster, is a pretty big disaster in my opinion. This is why inflation is coming down, but this is why earnings estimates still have a long way down to go, which I did show in one of the charts I had before that it's way above trend and it still has a long way down to go. And this is what the market is not waking up to, but it will wake up to this scenario. I believe it could be in the second half of 2023. This is what I talked about before, that whenever the market finally wakes up, that yes, bad news, it might be good news, but they are also bad news for earnings. This is when we could have pretty big surprises in the S&P 500. But on the short term, as I talked about before, the trend is still bullish. I talked about this trend line over here, that as long as we're above this trend lines that came from the March 2020 lows and we touched it on the October low, we are still in a bullish trend. And I also talked about me personally opening big short positions if we ever go below this trend. But as long as we're above, I'm still looking for many opportunities. I share them with you guys here on the channel. I do a video every single month talking about 2 undervalued stocks to consider, because we can't just be sitting every day, looking at the market. When is it going to reverse? What is going to happen? I mean, yes, such things are important to determine a pretty good cash position, but we can't just dedicate our entire life of when the market's gonna crash or if it's going to crash or not, which is why I would personally encourage you to look for opportunities as long as we're above the trend line. If we ever go below, this is when I would be very, very worried that we could bottom pretty close to 3200, which is a more likely bottom, a more fair bottom on fair value, not on overvalued stuff with no capitulation like what we've been having before. But most of the gains in the Nasdaq are actually coming in from 10 stocks. It says the top 10 Nasdaq 100 stocks in 2023 accounts for 88% of gains for the Nasdaq. So Apple, Microsoft, Meta, Amazon, Google. And that tells me, something, because if you look at the massive difference between the Nasdaq and the Russell 2000 is that investors are very worried about the economy and they are trying to hide in these mega cap names like Apple, like Microsoft, like Amazon and Google and Tesla. This is my only interpretation of this massive outperformance performers in the Nasdaq from the huge mega cap type of stocks. If you compare them to other stocks, some small cap Russell 2000s, I believe investors are very worried in the economy and they are trying to hide into Apple, Microsoft, and Amazon and Meta. But I believe they will eventually be wrong in the future whenever the earnings story finally comes in. Maybe not this quarter, maybe the second quarter, and then that could be, that there's no place to hide. Maybe the only place is TLT, which is why I made a video. I said all those things are pretty bullish for TLT, in the future, and it could be an amazing performer in 2023. This is what I believe could play out later on. But looking at a pretty, interesting chart, this is the DAX, is a Germany index. And if you look at most of the European indexes, they are actually pretty close to their all-time high, which is very, very interesting. And the question is, will the S&P 500 actually follow those, DAX and all those European type of ETFs? And if we compare, the S&P, which is now, I put it in the blue line, the DAX is the white line, and we compare them, they actually have, somewhat of some type of a correlation. It's not the best correlation in the world, but it's pretty close. And maybe the S&P is eventually going to follow the DAX and maybe be pretty close to all-time high. I would be very surprised if this happens, but it's something very, very interesting to watch. This is something else that I posted on my Twitter, which was, pretty surprising to me and many people. And this is a track record of the S&P 500 after it had a 7% gain or more in the first quarter. This is, it had, for example, 8.6% in 1954, 20% in 1987, and every time pretty much it has any gain above 7% in the first quarter, it pretty much never ended negative. It pretty much ended an amazing return. Like this is when it returned 9% in the first quarter. In 1995, it returned 34% for the entire year. And this is a very scary chart if you're a bearish person, where if we do return 7%, we could be looking up to 23%, which would take us pretty close to all-time high on the S&P 500 in 2023. Now, this is something very hard to believe that we could have such huge change in sentiment, but there's a lot of people actually calling for that, and this is a possibility. Also, in my opinion, it's a pretty, hard possibility, something hard to happen. There's always a first time. That could be the first time, but this is a pretty scary, data if you're bearish or if you're in the stock market in general, that whenever we had any gain more than 7% in the first quarter, we had pretty massive performers, and we never had a negative year on the full year return, which is a possibility, and it's something interesting to look at. But despite all those things we talked about today, there's always an opportunity in the market, and this is something that I posted on my Twitter, and this is the difference between the healthcare ETF and the Nasdaq. The Nasdaq is up 21% this year, and the healthcare ETF is down around 3.5%. This is because it's mostly a risk-off type of environment. Now, if the market does wake up that earnings estimates are very, very high, and these Nasdaq stocks are going to miss on earnings, they're going to dump the Nasdaq stocks and get back into healthcare and many of these other names like CVS and many others, which I talked about, and have pretty sustainable earnings. So this is an opportunity that I'm actually seeing right now. And I always say that there's an opportunity, in the market. If we were at 6,000 or 2,000 on the S&P, there's always an opportunity. But I try to make these videos to try to determine, what is a good cash position for us to have in such environment. And now, in my opinion, we have to be very, very selective in selecting the right companies that are going to do well in a bad economic environment, that are likely not going to miss on earnings. And most of the companies that are rallying are most likely going to miss on earnings. But I'm personally positioned in companies that will likely do well no matter what. It doesn't matter if we have a recession or inflation, or if the Fed hikes rates to 20%. These are necessity type of companies and are going to do well no matter what. This is how I'm mostly positioned, and I still have a pretty good cash position, which I'm trying to monetize a little bit in the options market to generate some return. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.